What if I told you there was a near zero risk investment opportunity for your cash that would pay you close to 5% on your money, had no early withdrawal penalty, and there was essentially no limit to how much you could invest into it? You might think I'm selling you something that's too good to be true, but I promise I'm not.
I can't lie!
I'm only trying to tell you about the humble T-bill. We saw I-bonds explode in popularity over the past year as rising interest rates and high inflation caused I-bond rates to peak as high as 9.62%. But as we also saw, there are a handful of drawbacks to investing your cash into I-bonds. You can't touch your money for a full year, you pay a penalty for taking your money out before 5 years have passed, and the most common complaint about I-bonds, you can only invest up to $15,000 per year. Well, T-bills are an answer to each one of those annoyances that we have with I-bonds. But what are T-bills? Essentially, there are three forms of debt that are issued by the US government. We have long-term debt offerings, which are Treasury bonds, and Treasury bonds mature in either 20 or 30-year time periods. We have medium-term debt, or Treasury notes. Treasury notes mature in ranges from 2 years to 7 years. And we have short-term debt, or Treasury bills. I-bonds, on the other hand, are a form of savings bond, which is a slightly different classification, but the way that they're structured is still meant to be a long-term offering. T-bills, on the other hand, are a short-term investment by definition. T-bills come in a variety of maturity dates, ranging anywhere from 1 month to 1 year in length. And T-bills can be sold at any time. No silly workarounds or disclaimers like we ran into with I-bonds. I call T-bills risk-free because they're issued by the US Treasury and backed by the full faith of the US government. So, barring a total government collapse, your money is safe when invested in T-bills. And it's because of their short-term and nearly risk-free nature that T-bills are among the safest and most liquid investment you could ever make with your money. You can get started investing in T-bills with as little as $100. The maximum you can invest in T-bills is $10 million, which I'm gonna go out on a limb and say is a limit none of us are ever gonna reach with our Treasury bill investments. But there are a few important things you should know and some interesting quirks about how T-bills work that you should know before rushing out and buying them. And for someone new to T-bills, the most difficult thing to wrap your mind around is how they do or actually don't pay interest. You see, because T-bills are structured as such a short-term investment, there is no regular interest payment. It's not like your savings account where interest is getting paid to you every month, or even like an I-bond where that interest is getting paid in every 6 months. So how T-bills work and how you actually go about earning that interest on T-bills has to do with how T-bills are sold. I said a second ago that T-bills are sold in $100 increments. And that's true. T-bills are sold in increments of $100, but they're only worth that $100 at maturity. Until that point, T-bills are sold at a discount to their face value. And this discount to the face value represents the interest rate or the return you can expect as the investor. And if that's still clear as mud, let me give you an example. Say the rate on a 52-week T-bill is 5%. That means the price you'd actually pay when you bought that T-bill is $95. Then after 1 year, at the maturity date of the T-bill, you'd be paid $100 for a return of 5% on your money. You put in 95, waited a year, and got 100. But how do we actually buy T-bills? There are two ways. The first way to buy T-bills is we log on to our good friend Treasury Direct. Treasury Direct is a website any of you I-bond investors are more than familiar with at this point. But when you log in, instead of going down and choosing I-bonds as your selection, you're going to see this top section labeled Marketable Securities, and we're going to select bills. From there, we're going to be given a long list of available T-bill options for purchase. You'll see maturity dates ranging from 4 weeks all the way up to 52 weeks as we've discussed, but you'll also see something a little different. For each maturity period, you see a handful of options with different dates next to them. Each option has an auction date, which is this first column, and an issue date, which is the second column. And that's because when a new batch of T-bills are going to be issued, they first go to an auction, and that's how the interest rate is actually set. So the first date in that list is the date that auction took place, and then a few days after the auction takes place, the T-bills are actually issued for sale. So for example, 52-week T-bills are usually auctioned on Tuesdays, and then issued on the Thursday following that Tuesday auction. All you really need to know here is that for each different date you see listed next to the maturity periods, those T-bills will have slightly different interest rates they're going to pay. So what you can do is click the little tiny link that's all the way at the bottom of the list to see what the interest rate is attached to the particular T-bill you were interested in purchasing. The other way you can buy T-bills is through your stock brokerage on what they call the secondary market. Most full-fledged brokers like Fidelity, Schwab, TD Ameritrade give you full access to the bond markets as well as the stock market. So buying T-bills there might be a good idea if you're someone looking to purchase them in a Roth IRA or other type of retirement account. There are also ETFs you can buy which invest specifically in T-bills, but in my opinion, it's easy enough to just buy them for free. So I don't know that I'd go through paying the ETF fee just to hold T-bills in an ETF, but you do you. You can also sell T-bills at any time you want. No lockup period, no penalties, but I will issue a word of warning. Because the interest rate changes on each new issuance of T-bills, selling your T-bills on the secondary market before they mature could lead to you losing money if the interest rates have risen since then and brand new T-bills are offering a higher rate of interest. This could also work in the opposite direction and work out to your favor if rates have decreased, but it's probably best practice just to pick the maturity date of T-bills that you're willing to hold them for and just hang on them until maturity. And now we've talked a lot about all the technical aspects of what T-bills are and how T-bills work, but we haven't really touched on why would you actually want to hold T-bills. I think the best use case for T-bills is as a backup to your emergency fund you're holding in a savings account, or as a place to store some cash you know you're going to need in the short term for a large purchase or expense. I see the question pop up all the time. I've got all this money saved up for a down payment on a house, but I'm not actually going to make the purchase for another 6 or 12 months. What can I do with it in the meantime to earn some extra money on that? And I think T-bills are a great answer to a situation like that. They provide an interest rate well above what you'll find in even the best high-yield savings accounts. And you know your money is more or less 100% safe while it's invested in T-bills. Because the last thing you'd want to do is take the down payment for your house, put it in the stock market, and then see it drop 20%. So that's where I think T-bills are a great piece of your overall financial puzzle. And all the money you earn from T-bills is exempt from all state and local income taxes. So holding some of your cash in T-bills also gives you a slight tax advantage over something like a high-yield savings account that way too. But all of this doesn't mean that T-bills aren't without their downsides. So let's take a look at some of the downsides to T-bills now. And the first downside to T-bills, and what differentiates them from a lot of other bond holdings you may have, is that they're not really an income-producing investment. Where other forms of bonds may pay out interest monthly, or even something like a dividend stock will pay out dividends quarterly. To get your return from T-bills, you have to hold for the full length of the bill in order to realize your return on your investment. The next downside to T-bills is something we touched on when we mentioned that you can sell them early, and that's the fact that the interest rate on new T-bills changes with every issuance. So if the interest rate on new T-bills keeps going up, the T-bills you've already purchased and are holding, the interest rate on those isn't going to adjust accordingly. So you're taking on some interest rate risk because in a scenario like that, you're going to lose out for the duration of the T-bills that you're holding. T-bills are such short-term investments that I really wouldn't worry too much about this unless you're planning on loading up on a bunch of 52-week T-bills. So if that's something you're planning on doing, just keep this in mind. Otherwise, I think all the durations are short enough where this really shouldn't be too big of a factor. And another downside to T-bills, which I gotta bring up because I know someone will mention it in the comments if I don't, is that T-bills are gonna be rather uncompetitive against the stock market. But again, I don't think this should be a big deterrent to investing in T-bills or not, because I don't think you should consider T-bills as an alternative to investing in the stock market. Like I mentioned before, they're best viewed as a complement or a backup to your existing emergency fund, or a place just to park some cash that you know you're going to need for some other purpose in the relative short term, and you just want to earn a bit more interest on it in the meantime. So like this video and subscribe to the channel if you haven't already. Be sure to check out this video next, and thank you for watching. I'll see you next time.